Traders, our man Jonathan has a lot of explaining to do. How did he lose $4.3 billion in the span of 4 months? We're going to talk about it here on a new series, The Worst Forex Trader of All Time. All right, traders, what's up, guys? We are going to go into a deep dive today on Mr. John MERIWEATHER. All right, I wanted to come out with a series that kind of exploited and helped you guys kind of see what a calamity is, like what a failure is in the financial markets when it comes to Forex traders, right? So I don't know how much research you guys do on Forex traders, hedge funds that are trading Forex, mutual funds, and different organizations and financial institutions that have a predominant portfolio weighed in currency markets, right? I do a lot of research in this. I did a lot of research in this in university, at the analyst jobs I've had, at the firm jobs I've had. We know what's going on in global markets, and we know what a lot of the market participants are doing in terms of strategies or in terms of certain assets or currencies that they're looking to trade in the future. Okay, so I want you guys to do the same thing. So here on this channel, we're gonna be doing a lot of breakdowns on some of the ups and downs of successes when it comes to hedge funds in the past decade, in the past 20 years or so, all right? And we're gonna be starting off with a fun one, Mr. John MERIWEATHER at Long-Term Capital Management. Okay, so I wanna set the stage here for Long-Term Capital Management because this is one of the most amazing stories when it comes to the hedge fund industry, all right? So imagine this, guys. Imagine you starting off your fund where you had two Nobel Peace Prize winners in the trenches with you. Okay, these Nobel Peace Prize winners won in economics, all right, studying economics and being able to rationalize in the economic game derivatives of price movements to a very fine degree. Basically, they could calculate very well certain price movements when it came to underlying assets, right? It's somewhat complex. That's why they won a Nobel Peace Prize, but these guys were expert economists that knew everything when it came to an economy, okay? Right, so you have Myron Scholes and Robert Merton. Okay, these are the guys that teamed up with John MERIWEATHER over at Long-Term Capital Management. But how do you get to economists that won Nobel Peace Prizes to join your fund? You have to probably be a pretty good trader. All right, so here's a quick history on John MERIWEATHER. Okay, the guy went to the Chicago Booth School of Finance, right? He got his MBA. All right, he's a very smart dude. He was one of the pinnacle forces that drove Salomon Brothers arbitrage group. Okay, again, this is very deep financial crap. All right, and if you're a retail trader, you may not know a lot of the words I'm saying, but it's very intricate. Okay, so arbitrage is when you're taking advantage of certain inequalities or inefficiencies in the marketplace. And so he ended up getting to the head of bond arbitrage at Salomon Brothers. He was a very well-renowned trader. He did really, really well in the 80s and in the early 70s after he got out of university. So after he left Salomon Brothers, he started his own fund, Long-Term Capital Management, okay? He started this fund with Nobel Peace Prize winners, quantitative physicists, PhDs, the top of the top of the top of individuals in mathematics, in psychology, and in economics, all right? So in 1994, literally after just 6 months of his formulation, he ended up getting the fund to over $200 million under assets. And then a year later, the fund had $1 billion under assets. And I think at that point, the pool of capital was closed. Now, these weren't just your average, just financial heads on Wall Street that were invested in this fund. You had celebrities in this fund. Johnny Depp was in this fund, right? You had the Asian Central Bank had capital in this fund. Yale's college pension, all right, Yale's university pension, the cash from the university had an endowment invested into the fund as well. Everyone was in this fund. Every big wig on Wall Street, a lot of the top celebrities, and even some central banks put capital into this fund. And then after a while, ended up growing all the way up into $4.7 billion before its collapse. Okay, so what was the fund's primary trading strategy? So again, the main strategy that they were implementing was an arbitrage strategy. The name of it is called quant convergence trading. So quantitative convergence trading. So anytime you're playing some type of convergence strategy, that's what my strategy is actually based on. You're trading a strategy where you're looking for asset prices to deviate from some kind of mean, right? So let's say you see a parabolic move in Apple stock, right? Well, maybe if you think that that move was way too fast and way too quick, you're basically now looking for a pull back down into structure in some capacity. Look, we're talking about structure, okay? And so they were doing a convergence trading strategy, and they were doing that strategy, again, looking for these extended moves in the bond market, okay? So they were looking at different currencies. They were based in Greenwich, Connecticut, and most of the trades that they were executing were outside of the US. So they were in Japan bonds, they were in Russian bonds. Those are actually what collapsed the fund. They were also trading emerging market stocks as well. They were really, really diversified. when you have a massive institution like how they did, you have to put your money in many different areas because you can literally move the market at that point, and there's less profitability if you have your entire size of a position in one asset class. So they were all over the world, okay? Year one, these guys got a 21% return on their money. Imagine getting a 21% return on $2 billion, right? That's absolutely insane, and you usually don't see those types of numbers inside of these markets, okay? Next year, they got a compounded 40% return. And so from 1994 all the way to 1998, long-term capital management had an annualized return of 40%. Okay, so what this basically means, annualized and compounded return of 40%. If I had $1,000 in 1994 and I pulled my $1,000 out before the actual fund collapsed, and maybe at the end of 1997, I would have made $4,000 on my money, right? $3,000 of profit. So again, imagine these enormous organizations, right? These massive banks, these very popular celebrities, right? People were begging to put their money into this fund because you had some guys who had $500 million invested into this fund who now have around $1.5 billion of capital. Okay, so immense amounts of wealth was created during the highlight, right? During the happy times at long-term capital management. Now, here's the problem with the strategy that they were executing. All right, and this is where the fund started to collapse. All right, so when you're doing arbitrage in the bond market, the way they were doing it, it has to be very highly leveraged. All right, so what this basically means is the price moves are so small. Yes, there is an opportunity. Yes, you can spot an asset or a bond price at maybe $105, but on your market side or in your arbitrage opportunity, maybe the asset's at $104. So you have a dollar opportunity right there, right? So what has to happen is to really expose that, you have to put on some serious leverage. You have to put on a lot of capital on that individual trade, right? I hope that makes sense to you guys. So again, if the price moves are small, there's not a lot of profit potential. But the more money you have on that price move, of course, the more capital you can make. So at the height of the firm's asset under management, around $4.6 billion, since they had to take advantage of these small price moves, they were leveraged. They were leveraged around 250 to 1. Okay, so basically, folks, what this meant was they had the buying power of almost $500 billion under assets, right? Of nearly over $500 billion under assets. Okay, so this is a massive mistake by Mr. John Meriwether. Okay, John Meriwether, back at Salomon Brothers, was known to be a highly leveraged trader. And what you guys are going to understand is most of the massive collapse from all of the big hedge funds happened because they had too much leverage on their positions. And so the first instance of when the firm really started to show itself in terms of its leverage being outlandish, outrageous, ridiculous, was during the Asian financial crisis in 1997, right? Ended up being around 1998 throughout that entire period. Okay, so again, it had to deal with the bond market. They were investing in the bonds in that market at the time. And so based off of their strategy, when you have an absurd amount of bond movement and lots of volatility, that's not what they need. They don't want a massive amount of volatility. They're trying to take advantage of very small incremental arbitrage opportunities. So when you have sporadic price movements, it's harder to spot, or it's harder to have a consistent edge, a consistent opportunity to take advantage of. So that was the first capitulation. They lost around $400 million on that individual trade. Doesn't sound like a lot, right? It's technically around 10% of the assets, which is a lot, but it's 10% of the assets. Okay, they've had a bad month, or they have an 8% month or a 9% month. This was a pretty bad month for them in early 2008, where they did have a 10%, almost 11% drawdown. Now, this is when things really started to unfold. Okay, there were two strategies that were happening almost at the same time. They were executing a strategy called equity pairs trading, and they were also inside of the Russian debt market. They were inside the Russian bond market as well. We'll talk about the Russian bond market first, because that's the main strategy that really blew up the fund, that made the equity pairs trading trade almost dissolve instantly after the Russian market fell. Okay, so what happened was that the Russian market was going through their own financial market collapse in 1998. All right, it was kind of happening almost all around the world, especially in these emerging market economies. What you ended up seeing was an option by the Russian government. Usually, when you have Russian bonds or a country about to default on its debt, usually they're going to turn on the printing press, right? Usually instead of defaulting on the debt, they're going to just print money to pay for the debt. That's what the US is doing right now, or they just stopped doing that in 2016, 2015. It's what Japan is doing right now. It's what the euro just stopped doing in December 2018, right? So many economies print money to avoid defaulting on their debt, right? And so back then in 1998, Russia had that same option. It was very well renowned to, hey, if you are going through issues where you're having a hard time keeping up with your payments, print some money. You can turn on the printing press and you can start doing some quantitative easing. It's one thing that you can do with fiat currency. You can make fake money to pay for your debt. Long-term capital management at the time thought that, hey, it's likely that they're going to turn on the printing press. Right now, there has been a massive sell-off, right? This is what they're saying. This is what John Meriwether is saying, and his boys, Myron and Mr. Robert. They all agreed that, hey, look, it's likely that Russia is going to turn on the printing press. There has been a massive decline in its currency over the past 5 or 6 months. We think that personally, that decline is what? Is going to converge back to the upside. This was the convergence strategy that they were implementing and they were using in the bond market. So you had a massive hit on the bonds. They thought eventually Russia would start to print money to bring their currency back to equilibrium. Russia decided not to. And this decision for Russia to not print money and to default on their debt, something the US has never done, that's why it's considered one of the safest currencies in the world. We will always print money here in the US. We just increased the spending bills in early Q1 2019 to print more money to pay for the government. We're always going to do it. Russia decided not to, and the second that happened, immediately long-term capital management lost $1 billion, all right? Right around 25-30% of their total assets. Now, again, this was leveraged capital. So they didn't really just lose $1 billion. They had payable $100 billion because of how highly leveraged their portfolio was at the time. This was so bad. This situation was so bad that the government had to step in. The New York Federal Reserve surveyed the assets in long-term capital management and realized so many investors were so heavy inside of this hedge fund that if they didn't bail them out and long-term capital management lost all of the investors' money, you might have a bank collapse and a potential financial market collapse in the US. This hedge fund was literally so big that it could literally break the bank here in the US. Absolutely amazing. So what ended up having to happen, the Federal Reserve of New York pulled together all of the large institutions, all of the large commercial banks, and loaned long-term capital management around $3.5 billion, okay? So imagine you having a fund so big that you had to call the SEC to bail you out if you lost all of your investors' money. Absolutely amazing. This is why these guys rank as really one of the worst traders, and they're not the worst traders. That's the thing, right? These guys are obviously really good at what they do, and John was great at Salomon Brothers, but these traders made a horrible decision to over leverage the portfolio to the amount that they did, right? So again, this is an instance where you guys can learn from massively on how over leveraging your portfolio can really detonate the account. Now, the story doesn't end there. Of course, long-term capital management did end up filing for bankruptcy right around 1999. But before 1999, John Meriwether started another firm. All right, at the end or at the middle part of 1999, and that firm lasted all the way up until 2008. He was able to get another $200 million within 1 year of starting his new firm, but of course the firm ended up shuttering its doors throughout the 2008 financial crisis, where in 1 year they lost 44% of their assets. So John at this point has pulled out. He's completely out of the business. Of course, he's still immensely wealthy because of proximity, but when it comes to managing assets, Mr. John Meriwether is going to be in the history books as one of the worst currency traders and bond traders of all time. All right, so guys, I want you to come back. We're going to do a video next on the best trader of all time, the best Forex trader of all time. I think you guys probably know who we're going to talk about here. I want you guys to guess down in the comment section below who you think the best Forex trader is of all time. He's very well renowned. Hopefully we can crank out on that video next week. It's going to be really exciting. I love to tell that story. And guys, do not over leverage your account. Instance after instance after instance shows that when you over leverage your portfolio, you're likely to blow up, like long-term capital management and Mr. John Meriwether. Okay, so guys, look, if you ever got any questions, let me know. Stay safe trading, folks. I'll talk to you guys soon.